this sort of thesis of buy and hold, which everybody talks about, we believe that era has passed. Our view is that bank will not exist in this form. The weightage of bank nifty in next 25 years will be below 10% if the bank don't change their thing. I always tell my team, don't give your perspective, show me data. Data is God. And when data is telling you, then you go all out. I'll give you a classic example, gold, silver. When we sold gold at 5,500 in January, okay, whole world was chasing gold. Silver, $114, $111 we sold. Everybody was talking about now becoming 250, 300. When we see this in our data, it was a classic euphoria sign. We just exited. When we believe global market has peaked out, particularly Taiwan, Korea, even I think this week US also has peaked out. I see far more deeper correction in these market in next few months. So at that stage, India is.
Hi there, welcome to Thrive by Groww. I'm Radhika Bajaj. My guest today is Sandeep Tandon. He is the founder and CIO at Quant Mutual Fund. Now, Quant's data-driven and macro-led investing style has challenged many assumptions about how portfolios are constructed and also managed. The fund house has also grown very rapidly, and it's now managing an AUM of over 1 lakh crore rupees. There are a lot of eyeballs on this rapid growth, and we have many questions to ask. So let's get started. Sandeep, thank you so much for giving us time on Thrive by Groww.
Thanks for coming to our office.
So Sandeep, it's we have many questions for you, but I want to just sort of get a broader picture before we get into the specifics. Looking at how the Indian market landscape has changed in the last couple of years, what are some of the surprising behaviors perhaps that you're noticing about the psychology of the Indian investor?
Very interesting question. In fact, I will say our real retail investor has become more mature. Okay. And I have seen in this change, particularly post-COVID as a phenomena. Okay. And why I'm saying that, in the past, we used to make comments, when retail comes and participate, that's the peak of the cycle. Okay. And it has been true on multiple occasions. If I have to go back from Harshad history of 1992 till 2018, I can tell you every time when retail participation has increased, market has peaked out. Okay. So it's always, people get excited at the peak of the cycle. At the market at new high, everybody is a long-term investor, everybody has a high risk appetite. Okay. And it's changed now. What post-COVID, very important phenomena, and it's not just a coincidence. What happened in around COVID time, people were sitting at home and they have surplus money because they were not enjoying life also at home. So a lot of saving came into picture. Okay. And they started indulging in the market on their own. Okay. And they made a lot of money. Where in 2020, best of the HNI, best of the family office, corporate who were worried, because anybody who was filthy rich was worried about his life. Okay, so most wealthy people are more worried about their life as compared to masses. Okay, it's a human psyche. And for them, hygiene and precaution was so vital. Where this sort of lower middle class family were enjoying their life with their family, the best time they could got in their life, and plus they were making money. Okay. What is very interesting is that at that moment when nobody was touching, they started putting money. And in next 1, 2, 3, 4 years, they made huge money. Okay. So we always have a thesis that every bull market has a leader. Okay. And leader plays a very important role. Let's say 2003, when bull run started in June 2003 in India and globally. In India, the leaders were FIs. They came and they pumped a lot of money, and the first time we heard the name of Fidelity or Goldman or Tiro, these names came into picture. And the cycle lasted till September 2007. They made tons of money. Then that Lehman crash happened. Post-crash, April 2009, the next bull run which started were led by HNI, family office, lot of PMS. Okay, these are the area AIF desk came into picture. From 2009 till 2018, they were the leader and they made tons of money. Post 2018 crash, that cycle peaked out in December 17 or January 2018. The new bull run started in April 2020, which is at that moment was difficult to visualize that will be a new bull run. That was led by retail. Okay. And now this retail has very large base. Okay, you look at the population of India, large investor base is there. They are sitting on massive gain of 30, 40, 200%, 400% return. That's sort of money they made. Okay, and that's the reason every time a market has corrected, they have not been affected. This is the first time real retail guys actually sense the importance of wealth because they made money. This whole thesis revolves around if you have huge mark-to-mark gains, you are more relaxed. If you are on the edge of that, then you are more stressed out. When you are so deep in the money, they were not affected, and that's the reason now it become a part of your life. Is something has changed. Earlier, when people used to invest in mutual fund market when they have surplus, today is a necessity. How you pay EMIs, people want to put money in mutual fund. Okay, so people will take out some 10, 20, 30% of their saving every month and deploy because they have understood the compounding effect. And they have also understood that if they held any trade for 5, 6 years, they're going to make money. And that is something which has changed. And that's the reason I said, if this bull run is led by retail, then this bull run has more legs, which means this cycle has potential to last for longer period of time. We believe till 2047 is the where our demographic cycle peaks out. So by 2040, 50, something has changed for India, and it's a great news for everybody. It's a phenomenal wealth creation opportunity.
So, I mean, so many things I want to unpack from there. I mean, COVID, of course, brought in some attractive valuations and there
Yes.
was a lot of awareness. People had that time to research and all of that. But isn't the same customer now also panicking a little bit, given the returns that they're getting now? Because, like you just said, they made money, they made 30%, 40% returns. They're not going to perhaps see that kind of return in the current market environment.
Correct. So the way I will look at is that yes, there is a disappointment. Okay. But it is less disappointment for the people who have invested in from 2020 onwards. It's more who came in the virtually at the peak of the cycle in December 2000, September 2024 or January 2025. The peak of the cycle when whoever has participated, they have suffered more losses. Okay. And their patience is getting tested, and we see in our numbers, the people who were the late who joined us, they are the first to redeem, or as market driver they still wants to move out, okay, because they are getting that exit. It's a psychological thesis which plays out everywhere. But the people who have invested for last 4 5 years, they have not changed. And if you really look at we also suffered in 2024-25, okay, that period for nearly 1 year, and last 1 year we came back in a big time. Okay, so I think people have understood if you remain invested with the mutual fund and a good money manager, they will come back very quickly. Okay, and it's a wrong to presume that you should pull out. A lot of people try to say that I have stopped my SIPA, I'll wait, let market correct, let it recover, then I will participate. Then you will not get that opportunity.
So I want to talk specifically about quant's signature framework, which is VLRT. So valuation, liquidity, and risk appetite and time. Right now, how does this actually work? Can you share an example and actually take us through how you apply this framework when you're picking companies?
So these are all analytical tools. Okay, when people generally talk about, we keep on hearing, we are fundamental guys. Okay, I believe everything is fundamental. Our VLRT framework is also 100% fundamental. Okay, when we talk about, we stand for valuation analytics. Okay, which is the backbone for any investment. That's the way all of us been groomed. Apart from valuation, I think liquidity analytics also plays a very important role. It's a lifeline. Okay, we very proudly say fundamental atma, liquidity the prana, and sentiments the maya. Okay, the maya is also important. The sentiment is very important. The only challenge is people are not able to quantify the sentiments. Okay, people are not able to quantify the liquidity. And talking about, let's say, when people say, oh, that was a risk on period, oh, market rallied, it was a risk, now it's a risk off period. So typically a lot of people tend to react when event is over. Okay, that phase is over, then you say that was the phase. So we have built an entire thesis on predictive analytics. Today you live in AI world, but we have been using our predictive analytics thesis for last 30 years, what we call quantum as a system which we have built, which incorporate all these factors. Let's take example of 2020. Okay, I will go for a larger picture first. Right from 2012 we have written how from 2019, end of 2019 till 2030 to 33 will be the most challenging phase, where the geopolitical volatility will rise. Okay, and we talked about a meltdown phase in 2020. It was written and published in 2012. Okay, so we have that background. I'm giving you example how you connect. Somewhere in September 2019, we spotted that pharmaceutical sector or healthcare as a sector has bottoming out. It reached neglected territory, which peaked out in somewhere in May, June 2015. So we were aggressively long on pharma, healthcare, IT, FMCG, and we have this aspect in mind. 2020 will be challenging and there could be a meltdown phase. Okay, we don't have a god status. But in January 2020, we saw euphoric phase in the leverage economy stocks, particularly banking sector, financial sector, which has a large weightage, 46% of the weightage for the Nifty components. And we saw euphoric move. And between January to March 2020, we liquidated the entire holding in the banking. We were to 31st March 2020, we didn't have any exposure in the banking. We didn't have any exposure in the material stocks or metals or commodities. Anything related to leverage economy, we sold. What we were owning? All FMCG, IT, consumption names. Now let's look at, so that background played a very important role. We were mentally prepared. This is a challenging time.
Very interesting.
Okay.
Yeah.
But that is a larger picture. 8 years back, we have predicted. Now you can't time it so, but in September, we noticed a bottoming of pharma, which means a beginning of risk off period. How the pharma bottoms out, that was the phase we look at. January, we saw a peak in banking names, means a classic signs of euphoria. 46% of the weightage is speaking out. Okay. So obviously we exited. Now let's say 2020 unfolded and COVID hit us. Okay, market crash big time in India and globally. Now it's the VLRT framework comes into picture. What we spotted, obviously, if somebody could ask me on 23rd March when market crash, is something has changed, valuation, fundamentally anything has changed, everybody could have answered nothing. This is just one-time event or it's a event which is unfolded. We have seen n number of times some Six Sigma event, market will come. But yes, fundamental lot of things got changed, which people understood after 6 months, 12 months, or 2 years that something got changed. But at that moment, nothing got changed. Yes, valuation became low. Okay, it was compressed. So out of VLRT framework, valuation analytics was in the right framework. If I have to give weightage, it was coming into picture. Now come to the second aspect, liquidity. Okay, because liquidity is so important, so all central bank globally came together and they started pumping liquidity. Okay, because liquidity also collapses. Okay, and this was how post Lehman crisis, after Lehman crisis is again event, we saw the liquidity suddenly disappeared. So March 2020 liquidity was at, for India it was 40 years, 50 years low. Okay, and for global market is the post World War II, it was the lowest point. It was lower or closer to Lehman crisis. Now you look at the third component, risk appetite, which is sentiments, and obviously sentiments collapsed. Okay, now you can feel it. We as a house, when we say quant, we quantify everything. We were able to quantify. So at the end of March, we spotted liquidity has shrunk completely. Risk appetite has collapsed, and by 15th April, we say risk appetite started increasing, liquidity started moving up. Whenever this is a lethal combination, after hitting lifetime lows, okay, in both the risk appetite and liquidity and start inching up, there's a lethal background for a perfect background for a bull run. And by 15th April, we were 100% deployed our money, where people were actually selling, because if COVID was unfolding and people were selling, it's a psychological game, I always say these analytics helps you because you cannot do rational thinking when there is a crisis. So all your tools which you have built, when they reach those extreme data points, so they are an extreme inflection points, either on the top perspective or bottom perspective, we are able to take call because there's no emotion at that stage. Okay, it has been built when everything was normal. Now we spotted this opportunity. 15th April, we were fully deployed. Now let's come mid-May and June 2020. By the time market rallied, okay, so people have not understood market rallied, and we spotted that month on month risk appetite was rising, month on month liquidity was rising, and when liquidity and risk appetite rises together, it's a classic sign that small cap and mid caps will do far better than the large cap because they are more dependent on risk appetite and liquidity. What happened very recently, I'll come to that also. So by end June, our portfolio were largely skewed towards mid and small, where whole world was in large cap, and they were adding banking and some of these name heavyweights and selling some of the mid and small cap. Okay, And that's the reason in 2020, 21, 22, when market, or 23 also, if you look at, our outperformance was, as compared to industry average, was not few percentage higher. It was times. We were few times of that number. Okay. And obviously, when you have taken up such a large lead, it really helps you. Now, let's come from a larger picture. July 2020-24, okay, we were first to talk about that our high frequency indicator are showing us a risk off period. I say it's a mild risk off. So we downgraded India as in something has changed for India, and obviously we have done extremely well, and we became more conscious. See, one has to understand from a risk perspective, uh, you have to be ahead of the curve in identifying the risk. Okay, so you may be lucky sometime the risk happen and the portfolio is not affected. You say, "Oh, nothing happened." Okay, but that's not the way we operate. We saw a risk off period. What you do in risk off period? We started cutting down mid and small, move towards large cap. Okay, and we moving from a high beta to low beta. That's the thing. Yes, market continues to perform till September 2024. So a quarter or 2 quarters, we were ahead of the curve. So we underperform also. That's also a part of a largely strategy and risk on. But come January 2025, December 2024, everything started collapsing. So something which we spotted 6-7 months early, we were very large. That's the reason from, let's say, taking for example, small cap, we were running 83%, 98% small cap. And within a small cap, we were running 35% either cash or large cap. So that's the way how rotation plays out. Okay. Now that's the thesis. Now look at I will not take it to 25 or something. Let's talk about 26. 1st April 2026. Okay. We were first to say, and upgrading India ISIS. India risk appetite has bottomed out. Liquidity has bottomed out. This is a mild risk on period. And in the fact sheet we wrote, it's a time to capitalize the opportunity, don't get capitulate. In 31st March, you see it was a low. People have virtually given up. And you see what happened. And we say after 2 years, we came and said that this is a time to buy small cap. Micro stocks will outperform small will outperform mid, and mid will outperform large. It played out reasonably well. It played out perfectly well. Okay. So how this is the way predictive analytics angle come into picture as a combination, we play a role.
I also want to understand how important is just the pure value aspect of it. Because the entire strategy is about factor investing, the market's shifting really, really fast. Quant is leaning more towards momentum. Are you, in fact, like chasing what's already rising?
So,
or, is the data towards...
I will say observation is not correct.
Okay.
We don't believe in factor investing.
Okay.
Factor investing has failed globally. It's an outdated concept. Okay, we live in a very dynamic world. Factor style is very static. I'll give 20% weightage, 30%, 20% to growth, momentum. That's not the way we operate. We live in a very evolving or continuously changing world. And hence our money management style is not static.
Very high rotation.
Yes. We play, it's not about rotation. We believe that if everything is changing, our money management style cannot be static. That's the reason we introduced the thesis of dynamic style of money management. India's first dynamic style of management is quant mutual fund. That's the way, because we understood if next 10, 12 years is going to be a challenging phase for the Indian market and global economy, then this sort of thesis of buy and hold, which everybody talks about, we believe that era has passed. Okay, we are student of adaptive asset allocation. Okay, somebody got an award for Nobel Peace Award for bringing this concept. We are very early to spot that. We see ultimately you have to adopt the prevailing. We are a largely macro house, so we don't chase momentum. We capture extreme inflection points. So if you are in a classic euphoric phase, we'll sell. Classic capitulation phase, we enter. So when you are selling at the capital or the euphoric phase, the probability of you missing out the next move is less. That does not mean that you have sold at the peak. Even we have sold 30% lower than the peak, then also we are very happy because somebody is giving me an exit with that position. Okay. We always say liquidity is highest at the peak of the cycle and liquidity is highest at the bottom of the cycle. So if you can exit at the peak of the cycle, your quantity will be absorbed. And if you can identify the inflection point, you can rebuild your position, somebody will give you a liquidity. So it works in your favor.
So there are many questions I have around those themes later, but just to close off the VLRT loop, if there is a DIY investor watching us right now, Is this something that they can learn? Is this methodology something that's practical for a retail investor to learn on their own? And if yes, what are the first 2 or 3 steps that they need to take?
See, first of all, they have to believe this thesis is effective. Okay. Today, the problem when we go for various forum, because we have been taught few wrong things. Okay, this is the way it should be. This is the way we should do. Like you said, churn is bad. Okay. Okay, it's a mindset game, because you have to grow in certain manner. We believe that first you have to accept we are living in a different world, and if you don't adopt new things, you will be irrelevant. So that's the reason we always say we written a book called Being Relevant.
Yeah.
Every time in the morning we'll come and we'll say, are we relevant? And that's the reason at the age of 57 I'm still learning. Okay, so quant is ever evolving fund. So if you cannot say that I have arrived in life, now I have said this is my models are working beautifully, okay, everything is sorted, let's relax, now everything is automated. That's not the way. It's a continuously evolving process. You have to keep on readjusting those things and ensure that the mistake which you have made should not get repeated. That's how a process comes into picture.
Yeah.
What is very key aspect is important to understand from a timing point of view. Okay, let me complete the VLRT framework. So timing is an analytical tool, it's a risk management tool. VLRT is the risk mitigation framework.
Yeah.
When a lot of people say, oh, timing is a trading thing. No, timing is, everybody wants to be a right place, right time. Okay, you tell me which investor, which money manager or fund manager does not want to time the market. If they're telling you we don't time the market, they're telling you lie. It is there in our subconscious mind. Who wants not? Everybody wants to be successful, na?
Yeah, of course.
Okay, it's a natural phenomenon. Everybody wants to make big money. So if somebody says that I don't time the market, no, it's a human psyche. They will time the market. This is a way of expressing. We as a house are very candid in our views. Timing is a risk mitigation team. Timing analytics is a function of valuation analytics. It's a function of risk appetite. It's a function of liquidity analytics. So timing as analytics is a function of multiple analytics, and that's the reason when we combine, let's say that's the reason we talk about that we run complex multivariates model. When multiple data points is skewed on one side, we take aggressive call, and something we are not getting a great picture or clarity, we lie low.
Okay, interesting. Now, one thing that you have said, we're already seeing signs of that coming true. You've said that multi-asset funds will become a very large component of how India invests. And in fact, I think in June itself, we've seen a 20% plus, money coming in into multi-asset funds. What makes you so positive about this category?
See, first of all, Indian investors were never exposed to commodities trading. Okay, as we are seeing this geopolitical environment, the importance of crude, or with the AI coming to picture or EV coming to picture, how the importance of some of the rare earth or let's say copper coming to picture or aluminum coming to picture, people have first time started understanding the importance of commodities and asset class. Okay, that's the important thing. It was largely debt or equity. Okay, if you're low risk guy, you go for debt. If you're high risk guy, you go for equity. That's not the way. Multi-asset fund actually gives you one of the best or superior risk adjusted return, because it's not about diversification within the particular asset class. We are talking about diversification in different asset class. We can have gold, silver, copper, aluminum, everything you can have in your thing. So diversification is better. And as a money manager, I always look at which schemes give me highest flexibility. The multi-asset fund gives me highest flexibility. Let's take example. A lot of people have participated into gold ETF, silver ETF. Okay, it's not like we don't offer, so I'm talking about it. Without understanding, there's a mad rush to buy. Okay, it's better to invest instead of these ETF. Put money in any of the mutual fund, multi-asset fund. Let the money manager takes a call when he wants to sell the gold. We sold our gold and silver in January 2026, virtually peak of the cycle, and we said on media, okay, this is the gold peak, and we talked about 3,800 gold coming, and closer to 40 mark will be on silver. We are approaching those numbers now.
So what are these macro indicators that then trigger you to move your allocation from one asset to another?
It's a complex question. Okay, see, we understand that we invest every year $1 million in data analytics. Okay, we invested so far $24 million in building our predictive analytics tools. So it's a complex thing. You can think of a data on a macro side. We subscribe and we try to build our own thesis around that. So it's a largely macroeconomic data which we subscribe, and we try to capture and build some hypothesis. This is our own proprietary knowledge, how we have built, how we quantify the risk appetite, how we define the liquidity aspect. It's a complex subject. Sometimes we are also lost because when you're dealing with so much data and you're not able to gauge out of. That's the reason we work on a skewness. And instead of looking at one parameter, we run thousands of parameters. Now in today's world, AI, you can actually process alternative data very easily. Okay, let's say example about how magnetic fields affects markets, how demographic affects markets. Okay, how Earth analytics plays an important role. Now these things we have never been taught. Okay, we have been only talk about how to look at the balance sheet and the cash flows. Okay, or sector understanding if you are have your specialization and you are being a sector. But it is also very important to understand these larger macro, then say, okay, there's a job of economist, I'm not economist. That's not the way it works. We as a house believe that macro understanding is must. Rather, government should put economic as a compulsory subject. Everybody should know economics and banking right from their childhood days. Okay, we all worried about mathematics and science and subject and biology, but nobody taught our economic and banking. Economy and banking is like a backbone for you, your own personal. That's the reason a lot of people make a lot of mistakes in their personal financing. I've seen early stage in insurance they've taken, but what insurance? Tiny insurance, which has no relevance. How the insurance number should be decided, they have no clue. Okay, what is the saving you should look at based on your need or goal based planning? They don't know.
Retirement plans, all of that.
So that's the reason the wealth management business I'm very optimistic, because people need advisor, people need hand holding.
So again, I know you said it's a complex thing to answer, but are there certain macro indicators that retail investors should always keep their eyes open for?
I have a very different perspective. Why retail investors should bother too much about these things? Okay, they are doing their own jobs or their own business. Let them focus. There is our money manager job. We as a money manager analyst has to focus. If somebody says that what analyst has to look at, then I can talk about it. Why somebody has to bother how the GDP is changing? You should know a breaking perspective. But why should you want to get a complexities
If I
of a
want
subject?
to invest directly and maybe, learn and be like a fund manager like yourself, if I want to learn.
So if you want to learn, then obviously analytics plays a very important role. You should have first, I said, economic knowledge is the most important thing. Then you come to the market, and then you come to the company specific thing. So first you gauge macro picture, how the inflation cycle, how the linkages between inflation and the interest rates or some other parameters which people look at. So it's a subject which over a period of time you can learn, but that knowledge is very important. It's a very, very important thing. What I say from a behavior perspective is about observations. Okay, I always say like buying is a art, okay, which lot of people have. Selling is a data science. Everybody does not know how to sell.
Please expand on that.
Okay, so let's talk about this thesis when people say buy and holds or sit tight for a long time. I'm a core holding, long term holding. Okay, now I will say this thesis was relevant in particular period when India was an emerging market. If you are in the early stage of emerging market or infancy stage of growth, then buy and hold strategy will give you phenomenal returns. Now I believe that India is no more emerging market. We are reasonably evolved market. If you are, we cannot say we are developed market, but we are evolved market. Even Korea, China, we are all evolved market. In the evolved market, this buy and hold thesis will not work. Okay, the first point. Second thing, as we are talking about globalization and interlinkages between various asset classes, various economies, and tomorrow morning you to see worried about what Trump make a statement, how crude is moving, how yields are moving. Now you cannot have a very static approach. If this is changing so fast, then you have to continuously rebalancing your portfolio. Okay, if you don't rebalance your portfolio, your portfolio may not be very relevant. Today, let's say in the particular sector of stocks are moving up in that category, and you say I don't like it, then it's fine. Then you have to suffer. See, our strength come into picture. Like when you say buy and hold, it's a buy hold strategy also work if you are in that environment. Till 2032, 33, I can say with good amount of our own predictive analytic thesis, this thesis will not work because data points are changing so rapidly. Okay, and if you say that I have a very static portfolio, this is my 10 years view. Some of the companies' thought process has changed. How the electronic media don't exist. Look at the some of the camera business or various businesses don't exist today. Have anybody thought of life will change? Your dependency on mobile will be so high. I don't carry any wallet. I don't have any watch. This mobile is everything for me. My life revolves around mobile. 10 years back, can you visualize that? Now with AI tools, okay, we think it is very difficult to visualize that. How can we function without that? Next generation even cannot think without Google God. Okay, so that's the way world is changing. And now you say I don't want to change my portfolio, then you will suffer. See, what is strength when we talk about continuously rotation and dynamic style based on the environment? I'm continuously rebalancing my portfolio. Rebalancing a portfolio is a part of a risk mitigation strategy. Okay,
Sure.
lot of people link with the churning, high churn. Churn has a negative connotation because in churn as a concept is only taught in India. Okay, global portfolio management, we have never learned a term like churn when we were studying. In our portfolio management books, it was always rebalancing. Okay, a private equity guy is rebalancing in 10 years or 5 years. Long accounts rebalance their portfolio sometime yearly or half yearly. A trader balance their portfolio on daily basis. If you are in that volatile world, I will prefer to my portfolio on dynamic manner. Okay, on continuous basis, things have changed. I will revamp my portfolio. And as a mutual fund, there is a huge tax efficiency. It doesn't hurt us at all. If I'm able to rebalance and I'm able to save money for investor or keep on generating some alpha. So alpha is about accumulation. Okay, you can't say I bought today, in 10 years will be 5 times. In between become half, then what happens? Okay, so people don't understand the risk of these things also. Our approach is that keep on accumulating alpha over a period of time by continuously rebalancing. Ultimately, you're accumulating alpha. Look at, I'll give you a very classic example. We as a house, we just released our success of VLRT framework, which we implemented in 2020. You will surprised to know that we did our analysis for 1, 3, 5, and 10 years. In 10 years, 80% of quant schemes are in top quartile, and we have 35 schemes. It's not like we have 1 or 2 schemes. In 5 years, 70% schemes are in top quartile. In 1 year, 90% schemes are in top quartile. Okay, and 3 years, slightly less. Okay, what is important to understand? 1, 3, 5, 10 years, if my majority schemes are in top quartile and some of them actually number 1. Okay, it showcased that VLRT framework has worked beautifully. And what returns? They have given an average return of 20% CAGR in 10 years. Or 20% CAGR numbers are something very important. Some of the schemes are even 25%. Even you take average of 20%, this is 20% is a very good number which we have generated. So VLRT framework has generated extraordinary alpha for 10 years perspective, 5 years perspective, because we are long term. But what is more important to understand, if you look at our risk adjusted return, then if it is more superior, because we have not taken that risk. Okay, people consider we are aggressive house, but we are actually very risk averse house. Okay, why we rotate our fund? Because we are very dynamically rebalancing my portfolio. Okay, we say with a lot of pride, we are in the business of risk management. Okay, we are in the business of risk management. Returns are byproduct. If I manage my risk well, returns will automatically come. Where lot many people are chasing returns. Okay, everybody talks about this IR I have generated, this is the returns I have built, so this is my future. No, you have to show me what is your risk adjusted return in 1, 3, 5, 10 years, then I will believe you.
So, Sandeep, like you were pointing out, you are rebalancing very frequently, quant is trading very frequently. That also does mean higher transaction fees, bigger short-term tax bill for the investor, right? How does your system ensure that the extra returns you generate easily beat that heavy tax and cost drag, if any?
So let me clarify. As a mutual fund, we are tax exempt. Short term, long term, dividend, every tax is exempt for a mutual fund. You as an investor only pay long term if you are holding for 1 year, which is 12.5, which is not very large number. Okay. Now, as per transaction tax is concerned, what we have to look at, if my churn or so-called rebalancing leads to higher trading, obviously we'll pay very low brokerage. That's the first point. B, what I am protecting, I'm saying how to reduce my impact cost. For me, the impact cost is more important. If my net return after the cost, if I'm generating positive, let's say I've generated 5% return and I paid 10 bips commissions also, or 50, after STT I paid 20 bips, let's for example, still I have made 4.8% return. Instead of holding and saying negative return or flat return, I've generated 4.8%. How does matter? Okay. What is important to understand is the impact cost reduction and the cumulative effect which plays. If I'm saying in 10 years or 5 years, my CAGR returns are 20%, we have given all answers. This is post-cost, these returns we are
Sure.
talking about. So I don't think anything is there. This is the all myth. We have grown with all these myth. Churn is high. This is bad for you. You pay more tax. First of all, you make money, na, then you pay tax. Okay? People are worried about tax, not about returns. I have learned lot many important lessons in when we used to invest on our own. Okay? In 2000, I never sold because of tax planning. And that's the biggest lesson in my never do tax planning in the market. If you're getting an opportunity, if your data point is saying it's time to exit, just exit. Because I thought, let me complete 1 year for my long-term perspective. I lost, and that time 70-80% of the value in the dot-com bubble. So I've learned lessons with my own money.
So, the other concern that sometimes is raised that your AUMs have exploded from, I think, about 235 crores in 2018 to now about 1 lakh crore rupees, right? Now, if you are this big, can you actually keep running a fast, highly active rotation or rebalancing strategy? How do you trade really at this scale without pushing stock prices against yourselves when you're buying or selling?
So, as size grows up, this is again second important myth. When you say size, when you stop performing, then you start blaming on the size. With this size, we can't churn, we can't rotate our portfolio. All bogus thesis. Okay. When I say it's bogus, because you should know when to exit. Okay. I'll give you example. I said when market is rallying, volumes are there. Let's say example of liquidity analytics. We have built on this thesis. जब तेजी आती है ना तो छप्पड़ फाड़ के पैसा आता है. और मंदी आती है तो जमीन फाड़ के शेयर निकलते हैं. Okay, the same thesis. Okay, when market is rising, liquidity is rising, you can get exit easily. I can sell that and maybe rebuild position somewhere else. The problem only comes when market becomes completely liquid, which was the case, let's say, in 2024, when the impact cost has risen. We are very much worried about impact cost. Why we started exiting from July 2024? Because February, March onwards, month on month, we spotted the impact cost is rising. And rising impact cost is a big alarm for us. Okay, if something is changing, this is something is not right, and liquidity risk is coming. Okay, so we are very vigilant on that front. So most important thing to understand, the size does not matter. It's a mindset game. Okay, if you want to sell after 30-40% fall, then obviously this is a problem, because nobody wants to sell when market is rising. You have to learn the ability to exit when market. That's the reason I always say nobody is sold at the peak. If even after you're selling something is rally, you should be happy that you got exit. Unless somebody makes money, they will not give you exit. Similarly, at the bottom of the cycle, you should have guts to buy. Okay, a lot of people I have heard, I will not touch the falling knife, let market dust settle down. I will buy 10% higher, I will not buy. Oh, that's opportunity loss. When you are getting opportunity, when everybody is vomiting or capitulating, there's a time extraordinary volumes are there. Why should not participate? So it's a thesis which we differ from others. Extreme inflection points have liquidity. Extreme inflection points, buying, selling is very easy. And extreme inflection points, my risk-adjusted returns are the best.
So you are talking about a lot of things that you believe that we need to unlearn, right? The buy and hold is one. You've also spoken about inflection points and timing and all of that.
Churn.
Right? Now, some people may say that buy and hold could be safer in the long run, right? Because sometimes when you react very quickly, when you panic and you sell.
In this changing world, you tell me, even you ask Warren Buffett, can you tell me in 10 years whether this company will exit or not? I don't think anybody
Banks will be there.
How are you sure about? Our view is that bank will not exist in this form. The weightage of bank nifty in next 25 years will be below 10% if the bank don't change their thing. We are moving to a digital world. It's a DG bank. This physical bank or this feudal bank, globally within central bank, that currency, CBDC we are talking about, the role of the commercial bank will decline. The central bank role will move up. Okay, I see a very negative future, a bleak future for banking industry in this manner. Okay, and that's the reason last 4 years banking sector has underperformed, though everybody is very bullish. Something is already changing and is writing on the walls. Okay, now have you anybody thought few years back the IT company will not be relevant? Today we are asking this question whether relevance. So this is all myth. to say that they will not change, they will exist. No, it's not necessary. So if I don't know whether company will exist after 10 years or not, why should I plan for 10 years? I don't mind rotating my money. Okay, I will review on regular basis, and if I like, I'll keep on continue investing. But I will not have a thesis that I'm buying today, and 10 years later on I look at my portfolio. Then you should go only in the private equity side. They have the 10-year vision. When they have 10-year vision, they buy very cheap.
Yeah.
Then they are part of the management. Okay, they are on the board of those companies. So they are also controlling the risk. They are in full control. That's the reason they are taking 10 years bet. If you are not in control of anything and being a small investor and say, I'm going to take a call on this company after 10 years, let me give you a very classic example. Okay, we say Bombay Exchange, BSC, blue chip index, correct? The word is all index are blue chip companies, blue chip companies. Sensex was the blue chip companies. Look at what was the Sensex in 1958, 76, 92. How many companies are there? Same BSC 30. Majority except Tisco, Reliance, few names over there from 92. Okay. Those company don't exist today. Okay. And those were the blue chip names. If the blue chip companies have disappeared, how can we say with certainty this company will last?
Sure.
Okay. So it's a different perspective how and in today's changing world, cycles are getting compressed. It's very difficult to visualize 10 years later. Okay. People are not able to visualize 10 months later. And market, so 10 days later also a lot of people don't have vision. So what we're talking
More
about?
so these days.
Yes.
Okay, I want to talk to you about some certain specific calls you've taken. For example, in November of 2024, Quant took a sharp single-day hit due to the Adani Group SEC news. And this, in a sense, exposed the risks of having highly concentrated bets. Now, how does the risk appetite part of your VLRT model justify taking such large positions in stocks that carry heavy regulatory or media noise?
First of all, you're doing a postmortem analysis.
Yes.
Doing a postmortem analysis is going to be very easy. Let's understand. Instead of looking at one company, I'll answer in a different manner. Okay. Ultimately, what you look at when we take concentrated bet, why we take concentrated bet? Okay, concentrated bet is a data dependent. Okay, if we like something, if your allocations, you identify a multi-bagger and what you allocate 0.5% of portfolio, it will not make any rounding error difference to you. Okay, so a lot of people say with proud, I identify this stock, but what much you, so unless you understand the importance of right allocations, that doesn't work. B, mathematically diversification looks good. We have been taught diversification reduces your risk, but extraordinary diversification is equally harmful for your portfolio. Mathematically, it can be proven. Okay. Now, what is important for us, the way we operate, is that how we identify company. Okay. We identify company on the cash flow basis, growth perspective. We don't bother about regulatory issues. So, US companies or the pharma company, every day they have run a regulatory risk. Finance company runs every day a regulatory risk. Okay. Now, regulatory risk is rising every day. Okay, and globally rules are becoming more and more stringent. Now, if I start getting into narratives, okay, people's agenda, okay, how can I help it? So, same example, you say people suffered. Yes, we suffered one day, is fine. Today, everybody wants to chase those same name because they are generating cash flow. They have delivered. Okay, so suddenly from extreme negative territory, best of the many managers who have denied this opportunity today are standing in a queue to participate in their QIPs. Okay, so for us, we were early in 95. So this business is all about early. Business is about conviction. His business is about clarity. Okay, and market rewards that.
Okay. Also in 2024, towards the end of the year, Quant turned defensive early, meaning you missed the final leg of the mid and small cap rally, and you just spoke about this as well. You've often said that you'd rather be safe than reckless. How do you advise investors to stay patient during those frustrating quarters when the rest of the market is actually chasing quick momentum gains?
Okay, so it's a interesting point. Let me put it in a different manner. We always say in a risk-on environment, as a fund house, we'll generate extraordinary returns or alpha. Okay, so and in difficult time, this extra alpha really protect us. Okay, because in the risk off period, we will logically underperform the market because we are taking a risk of call. And let's say we took a risk of call. What is important for us to understand, if you really want to understand how quant operate, okay, We are very active money manager. Okay, industry operates as a quasi passive management strategy. 80% I will give the same weightage to the index, and 20% I will play around. So your outperformance or underperformance will be very minimal. Let's say Nifty is given 10%, either you will do 10 and a half or 9 and a half. Okay, where we can be 25% also. Okay, what is important, because we have a mandate as a active, we take active management fees, we will deliver active management. Let's say example about this same thesis of extraordinary diversified mimicking indexes has failed globally. Okay, now look at last 2 years what happened. Okay, Korea, Taiwan, 2 companies in Taiwan, 6 companies in China, Korea, 9 companies in China, and maybe 22 odd companies in US. They were the extreme returns. If you're running a well diversified portfolio, your performance looks horrible or ugly as compared to fund manager who are running active money management and had taken a skewed and high conviction bet. They have made fortune out for their investors. Okay, now investor wants, and that's the reason now what happened, everybody wants to chase that. It's peaked out. So for us, an active management skill, volatility will be always on a higher side, but return is also on the higher side. What is important to do, neither you have to look at the return in isolation, nor you have to look at the volatility in isolation. You have to look at the risk adjusted return, what you got.
So, you spoke earlier in this interview also about buying in the neglected zone, when stocks are cheap and unloved. I think ITC and Reliance again are a few examples from, looking at your own strategy, and you sold them when they became admired and, of course, expensive. How does your mathematical model completely strip away human fear when you are buying assets and the rest of the market is actually moving away from those assets?
Okay. See, we as a house says that don't bring your personal biases. Okay, मेरे को अच्छा लगता है, मेरा view है. Okay, or some global houses view is this. Okay, has no value. I always tell my team, don't give your perspective. Show me data. Data is God. Okay, and when data is telling you, then you go all out. I'll give you a classic example: gold, silver. When we sold gold at 5,500 in January, okay, whole world was chasing gold. Okay, silver $114, $111 we sold. Everybody was talking about now becoming 250, 300. Okay, when we see this in our data, it was a classic euphoria sign. We just exited. Crude, I distinctly remember in February we said crude will rally, but we also never thought it will become 120. But at 120, one of the channel, a lot of global fund houses were there. They said now it is 150, 200, 250. And I said it will be 70 by November. Okay. Why we said? Because we work on a thesis of market implied analytics. The implied walls of crude in the month of April, if I'm not wrong, went up to 190 and collapsed to 60. It means market is not pricing the higher crude prices in the medium term. If the smart player, if market is not spiking, then whom we are there to conclude. Okay, so this is the way how you interpret the data. Data analytics very important. When it came $70, today we are running long crude oil in our multi-asset funds. Okay, whatever maximum we can take based on the open interest limit. We are long crude today. Okay, at $70, people have given up. Same one of the house talked about 60 and 45. So when you see this extreme thing, look at classic example, January to July 2024, when we downgraded India, between July to December, best of the global houses was upgrading India. Okay. Now when we upgraded India in January, in April, look at from February, March till now, most of the houses have downgraded India. So this is a very classic sign. I'm not making fun of anybody. Okay. What I'm trying to say is ultimately the people who are writing are also human beings. We play on human psyche. When the best person who believes who's the best economist in the world gives up, that's a sign of capitulation. The guy who was strongest and holding his view suddenly surrenders. That's a sign of a bottom. Okay. And it's not only one person, it's a combination we look at. Okay. And that's the reason we run multivariance model. Okay. I'm not concerned about one data point, because one data point can be distorted, managed and manipulated. Where multiple data points in the market cannot be manipulated simultaneously. Okay. So it's very important to understand the narrative versus reality. And if you can, with the help of analytics, we are able to see the reality. Okay. Otherwise, this business is all about narrative, and narratives are bought and sold. Narratives are created. Every day we do that.
So, what's your data actually telling you about themes like energy, infrastructure, and telecom? Because the rest of the world seems to be leaning towards those themes. Quant is not as enthusiastic as some of the other fund houses.
No, see, I tell you, we don't bothered what others are thinking. Okay, we believe that we are slave of data. Whatever our data point, we are very bullish on infra as a theme, power as a theme. For last 2 years, we are an overweight on pharma. Why our performance came because we are grossly overweight on pharma on the power sector because we were running a data center story. So telecom sectors or equipment companies and the power generation companies or anything related to thermal or new renewable. That's a theme which you're running. Since we are convinced about them, we are still holding them. Let's take example, neglected territory we talked about. We were negative from IT from September 2021 for a while. Okay. And we got benefit because they corrected sharply. Last 2 months, we have been buyer in tech. Okay. From zero, so we are 6 to 12%, in some scheme even 15% we have taken our portfolio. So we don't have any this love and hate relationship. Oh, we got success, our call was right, so let's not even touch it.
What triggered this?
Because the stock came in the neglected territory. Okay, and let's say example in 2020, we were the whole world was moving towards ESG as a thesis. We played anti-ESG thesis, and we made tons of money in buying power, defense, coal company. Today we are paying anti-AI theme. Okay, because we felt that AI thesis has peaked out in Korea, Taiwan, some companies, even Japan, China also. Reversal has started. So India will start getting money, and where India will get money? India will get money in the hard assets. Okay, and some of the tech companies which people have written off. Okay, completely. We believe tech role will change. They will become a AI enabler. Okay, somebody has to adapt these things. So adaptation of AI tools are also important. You and me cannot do it. You need software engineers to adapt these things for you, to understand the enterprise aspect and implement. So I think I'm not negative. So at every it's not about that something is good or bad. Every price is very important. Any stock is always good at particular price. Okay, you can't say this is a blue chip company. You buy peak of the cycle, then you will going to have losses. Okay, and even ugly company you buy at bottom of the prices, you will make tons of money out of that. Okay, so it's a we have to remove this emotional aspect. This is good, this is bad, and this is not the way. We as a house, we say we are opportunist, style agnostic, market cap agnostic, any thesis agnostic, pure opportunist. Wherever we get risk adjusted opportunity, not unwarranted risk. IT sector, we were very clear now when we bought, and we bought very selectively. The downside is limited. So we said, worst is behind us, best is yet to begin. So I'm not saying that best is begin. Worst is behind. If worst is behind, that means I can be selective in the stocks. Like in April, we said worst is behind for India. Okay, the whole world was not believing. If worst is behind, then you will get opportunity. So, and this is what exactly played out. Even this year, I believe it's not about index. You have to look at a stock specific opportunity. Index will not give you much returns.
Interesting. So, last couple of questions, Sandeep.
Yeah.
AMFI's stress tests show that the quant small cap fund, which manages over 31,000 crore rupees, would take 54 days to liquidate half its portfolio. To manage this risk, you hold significant positions in large cap stocks. Doesn't using large caps as a cushion dilute the true small cap mandate you've actually been promising investors?
So let me understand. See, the AMFI mandate is a very statical in nature. Okay, these are all very great academic ratios. Okay, on paper it looks nice. When Lehman crisis happened, whether this ratio would have affected that day, everything collapsed in 1 day or 2 days, 3 days. Did you get a chance to sell your portfolio in 54 days? In 3 days, you could have not sold. So these are very academic in nature. This looks very nice because for good reason we also track it. But if you say this is the way you will read it, now this is not the way we read it. Okay. Second point. Second point is very important. We have to understand what type of environment we are in. In risk on period, we were running very large, mid and small. Okay. Cycle was in our favor. In risk off period, I will play my stocks through large cap because what regulator has beautifully has done, they have not defined that you have to be 100% in large cap. Look, in small cap, they're 65%, and actually is very good. from a risk management point of view, at least as a money manager, I have a flexibility of 35%. So as a house, we will like to de-risk that opportunity. So I've been looking for de-risk. You looking for returns, I'm looking for risk. Now you look at what SEBI has done very recently, which is actually very good. They have allowed any equity scheme now can invest in bullion market. Oh, great news for us. It means a 35%, if I want to put my money in the small cap towards silver and gold at appropriate time, we as a macro house will be very happy to do it. It actually reduces my risk. So very grateful what SEBI has allowed us. This is not the case in globally. Okay. So I think the way we have to look at not everything from returns. Okay. Somebody says that, no, I have a mandate to do that. No, mandate is only 65. So let's not misrepresent. Okay. Because a lot of people say this is a small cap, I will put 100%. Then you will suffer also in the downtrend. If you are not able to manage your beta of the portfolio, then the problem starts. Let's look at SIF coming into picture. Okay. Now, SIF, what regulator has done is very interesting product, and we should be actually grateful to SEBI what they have offered. Okay. It's a long shot product. SEBI is first time allowing, as a money manager, I can protect my downside. At least 25% of my beta of my portfolio I can control. This is the best thing you can get. A lot of people have not understood the importance of SIF right now. Mark my words, in 10 years time, this category will be 50% of active mutual fund category. Because after 3-5 years, then people realize that risk adjusted returns are superior. Okay. And it's important. That's the reason we are very strongly advocating incremental money should come to SIF instead of mutual fund. So you should have 50% mutual fund, 50% SIF. Okay. If you have this combination, your risk adjusted return improves. Okay. You get better diversification. Okay. Let's say in 6 years time, I have as a general observation, you get 3 bull run, 3 downturn. Okay. So in a massive bull run, your mutual fund portfolio will outperform. In the downtrend or volatile market, that SIF portfolio will outperform. So the combination is a good thing.
Yeah.
So we are not saying only SIF. We are not saying only mutual fund schemes. We say combination. If you already have mutual fund scheme, please devote 100% of your money to SIF for a better rebalancing of your portfolio.
I think that's a great guideline for an evolved investor
Yeah.
to actually consider.
Not only involved,
Yeah.
even normal investor. Unless you invest, you will not understand. A lot of people think SIF is very risky. No, is actually risk adjusted returns will be higher in this thing. So any conservative guys who's putting money, a hybrid product or multi-asset fund like active asset regulator we have is a great product. They offer much lower risk as compared to equity schemes. So any conservative guy should put more money in SIF. That's a trend which is catching up globally.
And we'll watch out for it now that you've predicted it. You did talk about a lot of froth in SME IPO space. You're saying that tiny listings are getting massive oversubscriptions. Now, do you see this as heavy retail speculation, or do you also see this as a warning sign of some sort?
So this I said many quarters back, not very recently. So I think in 2024-25 I talked about. I still believe there is still a froth out there, not up to that extent what was there. But retail is not really participating up to that extent. It's largely HNI, family office. But it's a complex thing, they don't get allocation. So I don't think it will be fair to say that retail is participating. Retail is not participating. If you really sit down and analyze the shareholding pattern, it's largely HNI and the large family office or corporates who are participating, who are more involved and have more financial equipment and they have more risk appetite. Only those people are participating. We as a mutual fund also don't participate in that.
Okay, so you spoke about HNIs, and we're actually seeing a trend where a lot of wealthy investors are actually, putting money into US technology and physical gold alongside Indian equities. And if you put on your global liquidity lens, how do you see the competition for capital playing out between US assets and the Indian corporate earnings cycle over the next few years?
So, frankly speaking, again, I will give you a behavior perspective. Last 2 years, India has underperformed. And that's the reason the urge to diversify in global market and all gift city related many products, every manufacturer is getting into it. So it's a urge which is there, and you say suddenly you realize, oh, that's a diversification is better. Okay. So first, again, timing is wrong. Okay. When we believe global market has peaked out, particularly Taiwan, Korea, even I think this week US also has peaked out. Okay. I see far more deeper correction in these market in next few months. Okay. And within this calendar year itself. So at that stage, India is much more safer because India underperform. So at this stage, when people are very excited getting into offshore thing, I think timing is wrong. That's my first point. Yes, diversification is always good, but diversification at right time is important. Okay, like everybody got excited in January 2025, okay, or 26 about the gold silver, okay. So everybody was very excited. Now I look for diversification. This is the safest, liquidity is very high. What happened? 60% fall, 50% fall, okay. So I think as a house who specialize in timing, we will say this is not a great strategy at this stage. Indian equity looks far more safer in the context which I'm talking about. That's next five till 2032, 33, really challenging environment. And now the easy phase of bull run is over in even in Korea and Taiwan. So when we're talking about anti-AI thesis, okay, I'm not saying that the AI bubble has burst. I'm not even talking about, because AI bubble will only burst when we spread out to all the countries. So far, it was only confined to few country and few regions. This could be a euphoric top. Answer is yes, but this is not a bubble territory top. So I don't think that we should be worried too much about it. But obviously, they have rallied vertical moves, so they have to correct. So from a risk-adjusted point of view, India looks far superior.
Okay, I think that's a very positive note to end this conversation on. Sandeep, thank you so much for giving us time on Thrive by Grow. So, of course, we've got a lot of brilliant takeaways, a lot of things that Sandeep says that we as the next generation of retail investors actually have to unlearn. There are a lot of myths out there. His opinion on frequent active rotation is a very interesting one as well. And we hope you enjoyed listening to this edition of Thrive by Grow. Thank you very much for joining in.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Please read the risk disclosure documents carefully before investing in equity shares, derivatives, mutual fund, and or other instruments traded on the stock exchanges.